Okay, we seem to be live, and I'll welcome everyone to the Finance Committee meeting of Tuesday, April the 20th, 2021. I'll call the meeting to order and look to the agenda. Are there any changes to the agenda?
No changes from administration.
In which case I'll move the agenda be adopted as presented. Those in favor? Opposed? Motion is carried unanimously. Looking to the minutes of the January 22nd meeting of the Finance Committee, just a couple of editorial changes. The minutes reflect that there was council members present, but in fact, those were Finance Committee members present. And ditto with the next heading underneath. And on motions 36, 37, 38, and 39, there's just an extra word in the motion. Finance Committee recommend that Council to approve. I would think it was just recommend that Council approve the 2021 operating budget. I don't think we need to vote on those editorial changes. And with that, did we approve the minutes?
No, you did not.
Okay, I'll move the minutes be adopted as presented with those editorial changes noted. Those in favor? Opposed? Motion's carried unanimously. Moving on then to item D1, the Town of Canmore Consolidated Financial Statements for the year ended December 31st, 2020. Ms. Richardson, take it away.
Good morning, members of the Finance Committee. So as always, a huge amount of effort from the whole finance team has gone into the year-end and audit processes. Our statements have been audited by Avail Chartered Professional Accountants, who are our external auditors, in accordance with Canadian generally accepted auditing standards. This year was different in that the audit was conducted entirely remotely in response to COVID, but from our perspective at least, it still went extremely well. With that, I'll now hand it over to Mr. Scott and Ms. Lutz from Avail for their presentation this morning.
And welcome to you both. Thanks for joining us.
Thanks for having us. I'm having some video issues, so you won't be able to see me. Probably more fortunate for you than anything.
Okay, well,
but at least you got Michelle.
We'll struggle through it somehow, Calvin.
Wonderful. Michelle's going to lead the majority of this anyway, so I'll let her get started on the presentation.
Excellent.
Great. Thanks, Michelle.
Just bear with me a second here when I show my screen. Let me know if you can see it okay. There should be a slideshow with Town of Canmore Council presentation being shown. We're good?
Yeah, you bet.
Okay. So what we're going to be covering this morning is the independent auditor's report, the financial results, the notes to the financial statements. And at this point, we'll take a break for any questions that you may have. And then Calvin will be proceeding with the indicators of financial conditions. And then in camera, we will be going over the management letter and the post-audit letter. So starting with the independent auditor's report, we gave a clean opinion this year that the financial statements are presented fairly in accordance with the Canadian public sector accounting standards. It also goes on to note that management is responsible for the preparation and fair presentation of the statements in accordance with those accounting standards. Council is responsible to oversee management, and our responsibility as auditors is to identify and assess the risk of material misstatements, understand the internal controls, evaluate the policies and estimates used in the financial statements, conclude on the going concern assumption, and evaluate the presentation of the financial statements. So next are the financial results starting with revenues. So overall, revenues have decreased by approximately $9.2 million over prior year. The highlights in revenue are user fees and sale of goods are down by $12 million from 2019 down to 2020. So most of this relates to CCH housing resale revenues, which decreased from $12 million in 2020 or in 2019 down to 1 million in 2019, sorry. And then as well, there was a decrease in rec center revenues with COVID closures during the year.
Michelle, I'm sorry, is it possible to make the screen any larger? It's the
Is
printing
it
on
hard
the,
to see?
yeah.
Hmm.
If not, don't worry, but it's hard to read the numbers on the screen.
Yeah, I think that I don't know if I can actually zoom in here.
Okay, don't worry about it. That's fine.
Okay, my
We
apologies.
have all the information in the printed report
Okay,
regardless.
okay. So next are operating expenses. So overall, operating expenses have decreased by approximately $9.3 million. So most of this decrease relates to the I'm getting mixed up here. I didn't even continue on the revenue line items there. So I'm going to jump back and kind of restart. So we went over the user fees and sales of goods. And then the government transfers for operating, which is one line down, that has increased by $3.9 million. So that relates to the COVID grant called MOST, which stands for Municipal Operating Support Transfers. So total grant received for that was $4.2 million, and it was all spent in the current year. The items that it was spent on was $1.5 million towards the recreation loss, $150,000 towards the photo radar contract loss, $300,000 towards the utility revenue loss, $570,000 towards the direct COVID expenses, $355,000 towards the community social development, $281,000 towards economic development, and then $1.2 million towards the reduction of taxes. Investment income is up by $300,000 over prior year, and this is due to investments maturing and being redeemed during the year, resulting in gains on disposals of those investments. Development levies are up by $163,000, and this is due to the Spring Creek Mountain Village development, MD, a Bighorn Dead Man's Flat development, and then Moose Bay and Place GP Inc. condo developments. License and permits are down by $700,000 over prior year. There was lots of activity in 2019 where projects were being completed, so the decrease was anticipated and budgeted for. And then gain on disposal in the prior year relates to the sale of the old daycare lands. And rental is down by $145,000, and this is due to COVID closures. And then other revenue is up by $180,000, and this is just going to vary each year. Notable items included on that line item this year relates to the solar grant and the green trip funding.
Michelle, sorry if I could interrupt again. The government transfers are operating, which you talked about. In note 14, it doesn't break down which specific grants are covered in note 14. I'm just curious if do you have that information handy?
Let's see, I'm just gonna go to note 14 here.
There's transfers for operating, transfers for capital.
Oh yeah, so it's going to be included, yeah, all on that provincial conditional grant line. So you're just wanting the breakdown.
It's not critical. If you had it to hand, great. Otherwise, I know there's different grants that inform those numbers.
Generally on the operating side, we're going to be looking at the most grant will be included for the operating side, MSI operating, and any non-capital grants get shown here on the operating side.
Okay. Great, thank you.
Okay. So So next will be the expenses. So overall expenses have decreased by approximately $9.3 million. So most of this decrease relates to the public housing dropping by $10 million, which you'll see that line item about 3/4 of the way down on the slide. So similar to the decrease in housing revenues, this is the cost of the housing resale in CCH. And then starting back at the top for the highlights, admin is down by $190,000, and that's due to COVID cutbacks. Other protective services are up by $500,000, and that relates to a $355,000 accrual to a settlement with the RCMP, as there has been no settled contract since 2017. Road, streets, walks, and lighting is up by $400,000, and that's due to increased snow removal and pickled salt, as well as increase in snow and ice contracts. Public transit is up by $400,000, and that's due to increased route frequency between Banff and Canmore during the peak times of the day. As well, there was $300,000 of funding to the Transit for the MOST grant, which relates to the COVID grant. And then waste management is up by $360,000, and this is due to the large expansion of the organics program during the year. Parks and Rec are down by $400,000, and that's all COVID related with less staff and less costs. And then other recreation is also down by $800,000, and that's all COVID related again with less staff, less costs, with the rec center being closed for a good portion of the year. And then utilities are up by $1 million, and that just relates to the increase in the EPCOR contract. So overall expenses are in line with budget. Next will be the town's surplus. So as mentioned, revenue is down by $9.2 million. Expenses are down by $9.3 million. And this gives an increase of approximately $100,000 for the operating bottom line, coming in at $5.5 million before other revenue. And then other consists of government transfers for capital relating to the funds spent on current year capital asset acquisitions. So I'll be getting into the details of tangible capital assets on the next slide. And then the contributed tangible capital assets of the $6.5 million, that relates to the Stewart Creek Phase 3 development, where roads, sidewalks, utilities, lift station, and a playground were contributed. So overall surplus is noted to be $35 million. So this includes capital revenue, amortization, which is a non-cash expense, and the contributed asset revenue, but it does not include capital expenses, debt repayment, or transfers to and from reserves. Rick will present the bridge that accounts for a bunch of these adjustments. So actual operating surplus for the town alone comes in at $1.3 million. Next is the statement of cash flows. So starting at the top, it starts with the $35 million surplus, and then it takes into consideration adjustments for non-cash items, which relates to loss on disposal of capital assets, amortization, and contributed assets. Then it takes into considerations the town's working capital items from the prior year. So that will be the changes in accounts receivable, accounts payable, deposits, and such from the prior year. So total cash coming in from operations is $35 million. And then under cash flow from capital transactions, there's a net outflow of cash of $42 million. And most of that relates to the acquisition of tangible capital assets. So the highlights of the acquisitions this year are $18 million towards the Cougar Creek flood mitigation structure construction, $9 million towards the transportation improvement program, $2 million for the organics diversion program for the recycling center, $2 million for the South Bow River Loop water main, and $2 million for the New Life Christian Center lands. Under cash flow from investing transactions, there's cash flow coming in from investments of approximately $14 million, and that just relates to the redemptions and proceeds received on sale of investments. And then under financing transactions, there's cash coming in of $8.4 million net, and that relates to the new debt to help fund the capital asset acquisitions of $11 million. So overall, there's an increase in cash of approximately $15 million. When you add that to the beginning of the year balance of $40 million, that's how you end up at the $55 million at the end of the year. So next are the financial assets and liabilities. So overall, financial assets are up by $3.5 million. Starting with cash, the highlights, you'll see that there's an increase of $15 million, which we went over on the previous slide on the statement of cash flows. Taxes receivables are up by $240,000, and that's just due to the deadline extension for COVID relief. Trade receivables are up by $2 million, and that relates to a receivable for Cougar Creek flood mitigation structure project that's due from the province, and that relates to the new Building Canada Fund. And then investments are down by $14 million, which most of that offset is sitting in cash. Liabilities overall are up by $6.5 million. And starting with accounts payable and accrued liabilities, it's approximately up by $4 million over prior years. So most of this increase relates to a $3 million payable to the MD of Bighorn for their portion of the ACRP grant, which stands for Alberta Community Resilience Program. And then in addition, there's $350,000 accrued for the RCMP settlement. Deposits are up by $540,000, and that's just due to additional completion deposits received during the year, totaling approximately $744,000. Deferred revenue is down by $7 million, and that mostly relates to spending of the FREC fund, which I'll be getting into more details on the next slide when we go over deferred revenue. And then debt is up due to the new debt that was received during the year as discussed. So overall, decrease in net financial assets of $3 million over prior year, but the town still has sufficient financial assets to cover its liabilities, which is good, healthy financial condition to be in at the end of the year. Next is the deferred revenue note to the financial statements. So this is just here for informational purposes, showing the decrease of $7 million over the prior year. You'll see most of that decrease, a few line items down under the flood recovery erosion control program, where in the prior year there was a $15 million balance, and then this year there's about a $3.4 million balance. So those grant funds were spent on the Cougar Creek flow retention structure project during the year. For non-financial assets, this consists of the town's prepaids, inventory, and tangible capital assets. No major changes in prepaids and inventory. And then tangible capital assets are up just due to the current year acquisitions as discussed. And then accumulated surplus is broken down between unrestricted surplus, internally restricted surplus, which are the reserves, and then equity and tangible capital assets. So unrestricted surplus is down just a little bit. Internally restricted surplus is up by $5.7 million. So I'll be showing the breakdown of the reserves on the next slide. And then equity and tangible capital assets is up by $30 million. And that just relates to the $48 million of additions this year, including contributed assets, less current year amortization of $9 million, less new debt proceeds of $11 million. So next is the reserve note, which again is for informational purposes, where you can see overall there was an increase to reserves of approximately $5.7 million. So the reserve note is broken down between the operating reserves and the capital reserves. So just to highlight the major changes, under operating, there was use of the general operating reserve and then an increase to the tax stabilization reserve. There was also under capital increase to the asset replacement reserve, use of the general capital, use of the offset levies, and use of the water and wastewater utilities. And then the other increase in reserves related to the work in progress debt reserve. And then for the town's debt limits, this slide shows the town's total debt and servicing limits as defined by the Municipal Government Act. So just remember to normalize the calculation for one-off items as it is based on the town's total revenues. And then it's also important to note that the figure shown on this slide only relates to the town's numbers and doesn't include any of the other entities that are consolidated into the town's financial statements, just as it may be misleading. And this was the way that was chosen to be presented by management and a council, which was approved years ago. So it's the same presentation there. And then last is our COVID-19 disclosure note. So this is standard across all of our municipal clients, which just notes the potential impacts on the town's business and operations, and that there's still a lot of uncertainty surrounding the pandemic and COVID-19 at this time. Any questions with what we've went over so far?
I have a number of questions, but I'm hesitant to raise them now. I don't want to interrupt your presentation. You might speak about, so I'll hold my
Okay.
questions for now.
Okay, so Calvin will proceed with the indicators of financial condition. So I'm just gonna stop sharing.
Well, if we're going, sorry, if we're going
Oh.
into the indicators, yeah, then I will ask a few questions right
Okay.
now, just to help me make my way through these mazes again. So in the consolidated statement of financial position, the cash and temporary investments are up by 15 million this year from last year. And in the notes, I can see the funds moving back and forth. So yeah, in note 2, I'm just curious, and I think I've asked similar questions in years past, but why there's so much in cash at year end for in note 2, 37 million over, well, last year was, or 2019 was 13 million in
And
cash.
happy to help with this one as well, since the presentation, so the top line there, cash, it does also include temporary investments. So similar to prior years, what ends up in that top line versus the last line in financial assets there, investments also has to do with maturity date. So it isn't necessarily that we're sitting on, and again, it's consolidated, so it's not just our cash, but also the consolidated entities, CCH, the library and the BIA, but that would include also investments that are maturing in the short term.
Right.
So
I mean, I get it that it's not cash sitting in the bank, but and I know how investments, mature, and so it just happens that in 2020 there was quite a bit more of our investments in those short-term.
And part of that was strategic on our part as well, given the uncertainties of COVID and also the number of significant capital projects going on, like the Cougar Creek retention structure. We were also intentionally keeping more of our investments in more flexible, liquid investment types rather than long-term, given the year we had.
And that was really the detail I was curious about, that it was intentional, and I appreciate understanding that. Thank you. Question on note 8, the long-term debt. It notes that the debenture debt has a range of interest at rates ranging from 1.789% to 8.375% per annum. I'm just trying to remember when it was that, how long ago the rates were as high as 8.4 effectively. It seems like it's, so I guess my question is, how old is that debenture that's referenced at that highest interest rate? And when will that be paid out?
Yes, just bear with me one. So at the high rate.
I can probably answer that.
Thanks, Rick.
back in August of 21, a couple of the wastewater treatment plants from 1993 mature. They were at around 9%, 8.5%, 9%. Yeah, though most of those old ones are going to mature in the next couple of years for sure. Our
Great.
highest one, yeah.
Great. I'm just looking to see if any other members of the committee have questions before this moves on. Are there any questions? Okay, seeing none.
Okay, so I will stop sharing my screen and pass it off to Calvin.
Great, thank you.
Hopefully I can actually share my screen this time and you can see something. Is that working? Can you see it?
The same issue, but that's fine. I can follow along in the printed version.
Perfect. It's odd. I've got it on the wide screen, so it should show up, but we'll make sure you can see it there. So the first thing we'll start with is the indicators of financial condition, just so you're aware of what these lines mean and what the comparatives look like. The blue line that you'll see on these graphs would be the town of Canmore, so that's going to be your results. The red line that you see is going to be the average of all towns in Alberta. The green line, which is probably the most important, is going to be the comparable town average. So towns with the same population. There's only 3 other towns within a standard deviation of yours. That includes High River, Strathmore, and Sylvan Lake. 2 of those happen to be our clients as well, so right in that same ballpark. And the last line you'll see is going to be the purple line, and that will be the comparable population, but of any type of municipality. So it'll include the 3 we just mentioned, as well as any counties or MDs that happen to have a similar population. The city of Brooks also falls into that category, and there's 16 in there. But probably the most comparable would be similar sized towns, and that would be the green line to worry about. So the first thing we'll look at is the assets to liabilities. So total assets, this is going to be all of your cash, receivables, everything you own, as well as your tangible capital assets, so all the infrastructure, in comparison to the total liabilities or what you owe. We're looking at about a ratio of 5.3 here. So you're right in line with comparable town sizes. This has come up this year with increased debt and with increased tangible capital assets. So some debt, some deferred revenue and reserves spent, but not a significant change from last year. And you're right in line with other municipalities of the same size as yourself, other towns the same size as yourself. So not a significant change in where we'd expect to be. The financial assets to liabilities. So on this side, we take out the tangible capital assets and compare just the financial assets. This is going to be your cash, investments, receivables. You can see that the town actually comes up a little bit in comparison to that average. Down a tiny bit from last year, from 1.2 to 1.16. This is due to having some additional debt come out this year, but right in line with the average of comparable towns, not significantly out of place whatsoever, and not significantly high either. The current ratio, which is going to be current assets. So we take out long-term investments, which can definitely have an effect on stuff depending on if you have your cash sitting in a cash account, temporary investments, or in long-term. Right now we can see that we're up on the cash side, as we discussed, and those current liabilities would take out any deferred revenue or long-term debt, so any externally restricted funds. You see that there's essentially 0 change for the town this year. Even though the current assets went up, the current liabilities increased by the same amount, and staying low on this side. So overall, this is going to say that you're going to be holding some deferred revenue to push that up to offset that debt. No significant change here. And being on the low side here isn't necessarily a bad thing. This shows you what your current assets. So if you had to pay off your immediately due amounts right now with what you have, you're still going to have much of a net financial asset position, which Michelle mentioned earlier. So you're still in a good, healthy position and not significantly over on a high side by any means. Next one we'll look at is the operating expenses to the taxable assessment. So generally this would say you can read this one of two ways. Either you have an extremely high taxable assessment or you're operating lean and keeping your operating expenses on the low side. You'll see that the blue line here for the town is at the bottom and trending downwards. So the operating expenses decrease this year. Last year we had a lot of costs associated with CCH and the old daycare development. And we can see that with those expenses coming down, that the operating expenses to taxable assessment has decreased this year. You also note the taxable assessment has increased fairly significantly from 6.8 to about 7.5. So low on an overall basis here.
Calvin, if we were, breaking down the taxable assessment of the comparator communities, would you expect to find there's quite a gap between taxable assessment in Canmore?
Yeah, I think your taxable assessment's going to be higher in comparison to the other three that we're showing, and in general, a little bit on the higher side.
So that would affect the chart here. Presumably.
Absolutely, that's what keeps you on the low end of this side for sure.
Right. Thank you.
On the public debt charges to revenue, so we can see a spike coming up this year. Operating revenues did go down. So generally, if we're going to have any flood revenue, anything of the sort, like in prior years, we had a lot of FREC revenues coming in. This year, that's going to be down. Last year, there's also housing sales that brought up that operating revenue. You can see that the operating revenue came back to about the 2018 levels. However, the debt servicing with new debt for capital projects went up. So we can see the spike that occurred this year, and this can go up or down. And mainly this was affected by the debt servicing for the current year.
With many of these charts, I don't know how impacting it is, but I recognize that we're showing our 2020 numbers, and in this case of this chart, it's going up. It could be that when you have the numbers for those other three lines, they will also go up. I mean,
they could be doing exactly the same thing. Yeah, we don't get the comparatives, unfortunately, till next year. So that's what makes it tough.
Right.
And generally, we would see operating revenues, depending. In your case, I would think most operating revenues would be staying around similar. We'd have some additional grants for the most program. Your financial statements, being they included the revenues for the house sales last year, would have been higher. So without those, you probably would have been a little bit above average last year. And the additional debt would have just pushed you up this year. And as that gets repaid, then you'd be coming back down again.
Great, thank you.
On the debt to revenue percentage, so if we're looking at the previous one, which is public debt charges, so the debt servicing to operating revenues, and now we look at the total long-term debt to total revenue. So this includes the capital revenues. You can see it coming down a little bit from 2018 to 19, and then shooting up a little bit in 2020. So the reason we're going to come up this year again is with the additional increase in debt. The 2018 increase, you can see that related to the Canmore Rec Center. I think there was $5 million of debt that came in 18 for that, as well as about 1.5 for the water treatment plant and the lift station. So that was the debt taken out that pushed that peak in 2018. And this year we're going to see that increase again. And the total revenues offset, you'll see a significant increase between 2018 and 2020 as well. A lot of capital revenues coming through, 89 million this year versus 62 back in 18. So a little bit above average, but that can definitely flow again with 2020 if capital projects are up and other debt is taken in those other comparable municipalities, you'd be right there. But again, anytime there's new debt, it significantly affects these ratios.
When we look at a chart, an indicator chart like that, and notice the Canmore line is above or quite a bit above the others in some years, is that, I never look at that and see an alarm bell going off. I'm just, I'm appreciating the information. It's just showing how it ebbs and flows. But in this particular indicator, the fact that the Canmore line on that indicator is always above the others? What does that mean?
Well, at this point in time, it would simply show that your the amount of principal debt that you have in comparison to your total revenues on an annual basis is around 50%. So it would say that you have higher debt in comparison to the other municipalities in this case. On an overall basis, you'd be carrying a larger debt load is what it would mean, but you're not at a significant rate higher at this point in time.
And if that balance was unhealthy, it would show differently on the chart like this, or?
If this balance was extremely unhealthy, you'd be way up near the further beyond the top of this if you were going to be in an unhealthy position. And we'd be discussing that with you far ahead of
Right.
this meeting if that were the case.
Great, thanks.
You bet. The next slide would be the infrastructure investment. So this shows the investment you're making in capital on an annual basis in comparison to annual amortization. So are your assets spending, or is your asset spending outdoing the depreciation of your amortization? So you can see this year there's $41 million of capital expenditures and only close to $10 million of annual amortization. So you're spending 4 times more than the depreciation. And as you can see, all of these charts vary depending on the averages and what spending's going on. But generally in the last couple of years, you can see in similar size towns, there's been a lot of capital spending going on for sure. A lot of infrastructure investment has been made as of late.
Councillor Comfort has a question.
You bet.
Thank you, Mr. Scott. My question is, on our comparator communities or towns, they may not have necessarily the same amenities that we do. How do you account for that? How do you make any kind of allowance for that?
Absolutely not. So the thing with these is that the comparative information is taken from essentially directly from the financial statements. So the annual financial statements that come in, that's where we pull a report directly from the provincial government that shows their financial statements. So depending on how they account for capital asset additions, there's a lot of things that might happen as far as some of their additions, depending on the policies. So some municipalities would redo a road. They would have their roads broken down into layers. Every time they take off the top layer, they're going to replace that, and that will be an asset disposal and a replacement and a new addition. In other municipalities, that's simply repairs and maintenance, and it's an operating expense. So there's definitely different accounting that can affect these numbers depending on what is capitalized versus expensed. As far as the amenities go, it's absolutely not in there. Whatever is shown as tangible capital asset additions for the current year, regardless of what goes in, is there. So yes, if you have more amenities, you are going to have greater capital asset additions. And it is not reflected by any means in who has more, simply a dollar amount for comparative purposes.
Great, thank you.
You bet. The own source revenues to taxable assessment. So this takes all of your revenues and subtracts any government transfers, whether those be operating or capital. So you can see you are on the lower side here with 0.81 in comparison. So that ratios decrease a little bit. So your own source revenues would have been up last year, mainly because of CCH's property sales of about $11 million. So that would have changed this year. So having significantly less, we're going to see a decrease, which means that you're taking in less government revenues or less general revenues than you did in the prior year. So this is going to show that you're on the lower end of this and being less reliant on the government for funding. Although in the current year, when we see the next one, you're going to be high there. So as capital happens, we can see a significant increase this year. So government transfers were through the roof as far as the current year is compared to last year, 11 million versus 28. And we can see with $41 million of capital additions, we're going to have some significant government funding that comes in to support those additions. This government transfers will generally follow with the investment in infrastructure, as generally most municipalities aren't funding 100% of their own infrastructure. The good news indicators or the, oh, sorry,
Calvin, could you
yes,
go back to the last
not a
indicator?
problem.
Vulnerability. So it shows quite a sharp uptick there. Are those numbers in the 2020 line, are those higher in the way they are because of, or is that COVID related?
No, so the total revenues including capital. So this year's revenues are going to include the most funding. So that will be up a little bit because of COVID, but generally it's going to be just because of the funding that's been recognized. So a lot of it is going to be funds that have been received in prior years that were spent this year.
Okay,
Whether those be FREC funds, MSI capital, whatever that might be, a reduction
Right.
in deferred revenue.
right,
So that all comes in, but generally the only COVID related funding for the most part would just be the most funding that shows there.
right. Okay, thanks very much.
The reserves to total accumulated surplus. So this is going to show you essentially the value, if you will, or the financial health of the organization. So this shows what your overall accumulated surplus would be, which is about 384 million. And of that, what makes up the restricted amount. So you can see that you're sitting higher than the comparative municipalities. Some of this could be shown as what portion is restricted versus sitting in unrestricted. You have a nice healthy, as an organization, a good healthy reserve balance. So anytime there's additional funds being earmarked for other capital or operating, put away to help subsidize future taxes or capital. So sitting in a nice healthy reserve balance that you can see. Not the highest by any means, but definitely not the lowest. And the last slide would just show accumulated surplus available for future use. So you can see the unrestricted balance is at about $10 million. The restricted, as we just looked at, is at 53. So your accumulated surplus overall, or the health of the town, is well above any of the comparatives. So sitting with a good amount in the bank and support for future years. I wouldn't say it's too high by any means, but definitely above the comparative balances as far as the unrestricted and restricted go. So healthy reserves to help fund future capital and operating, and a good piggy bank to sit on as far as 10 million in unrestricted. And these numbers can change significantly given any emergencies that may happen at any point in time, or using up your restricted amounts for future capital. Those can decrease fairly quickly. So just note that those can change at any point in time. But right now, at the end of December, sitting in a good, healthy position for sure.
And if you've noted that this is not a bad situation to be in, what would a bad situation, I mean, if that blue line was quite a bit higher, what does that mean?
If the blue line is significantly higher, it means you're sitting on a lot of funds that you would have, depending if it's sitting in the unrestricted or the restricted. But if you had the restricted amount there, it would mean you have earmarked a lot of funds for future projects, whether those be operating or capital, that have remained unspent. So potentially you are saving up to do large construction that you're funding on your own. But you might be sitting there if it was too high, if the blue line gets too high, that you have too much money sitting on your hands at that point in time. That is not necessarily going to be used for anything. So that's when taxpayers start thinking the taxes are too high when that line gets too high.
Right. And then that's where my thoughts were going. I see that indicator as being healthy at this time, and you indicated it is healthy. It's not too much accumulated surplus.
Yes, and as council earmarks projects for capital, that can definitely come down. As Michelle went through those balances earlier, the significant portion of those restricted balances are in for capital projects. So as those projects occur, that will definitely come down in the future.
Great.
And that's just good planning for capital projects.
Thank you.
And that would be the end of the comparatives for you. So we'll leave it out for if there's any other questions.
Did we talk about the final two, the tax base ratio and the population change, or is that?
We don't generally run through those because there's not a significant change in
Right.
those on
Yeah.
a regular basis.
Great. Well, I asked my questions as we went along. Councillor Sanford.
Thank you, Mayor Barman. Thank you, Mr. Scott, for the presentation. My question is actually refers to just the previous slide that you were on.
You bet.
The accumulated surplus restricted. Are those restricted amounts generally from grants and other government transfers?
Generally, anything that's going to be coming for grants would sit in deferred revenue. So if I can, I'll bring you back to this slide that actually shows what those reserves are. So you can see what a lot of these are. Like the asset replacement, it wouldn't be in a grant. The tax stabilization, not going to be grants. So generally, any of the grants would remain, if they're unspent grants, in deferred revenue. These are going to be internally generated funds for the most part that have been put away for future use.
So that restricted surplus is in special reserve accounts like the tax stabilization account.
Correct. That entire 53 is all for specific purposes.
Okay. Okay. Thank you.
And it is cash covered in your case, so that's a good thing as well to note.
Thank
You
Are there
haven't
other
put away
questions?
money that you don't have.
Right. Other questions for Mr. Scott or Ms. Lutz? Seeing none. Did we want to, was the intent to go in camera before putting the motion forward to accept the statements?
We can do either. Absolutely your call.
Okay. Well, let's do that then, and have a little quiet chat. So with that, I'll move that Finance Committee take the meeting in camera to prevent disclosure of personnel evaluations in accordance with Section 17(4)(f) of the Freedom of Information and Protection of Privacy Act. Those in favor? Opposed? We're going in camera. There we go. I believe we're all back in the main meeting. 1, 2, 3, 4, 5, 7. Yep, we're all back. Okay, that will bring us to the last part of the meeting, which is the motion. And I'll move the Finance Committee accept the Town of Canmore's consolidated financial statements for the year ended December 31st, 2020, as presented. And I'll speak in support of that motion. Given all that we've gone through the last year, I think these financial statements are awesome. I think the Town of Canmore, and I'm not crediting council on this, Town of Canmore administration, particularly in the finance department, are doing an awesome job. And it helps council with our work, knowing that, having that confidence in the work that our own team are doing, particularly in a difficult year like COVID, and having that confidence confirmed every year through an independent audit, as we do. So I'm very happy to support the motion. The discussion on the motion, Councillor McCallum.
Thank you, Mayor Barman. I too would be happy to support this motion. This has been a very difficult year, and our staff have stepped up to the challenge. As we just heard in camera, our auditors have felt that our staff do an amazing job every year and that we're lucky to have them. And I would agree that we are lucky to have them. And so they have managed to keep us on task, on track financially, and these audited financials are a statement to that dedication to their job. So I'll be happy to support the motion. Thank you.
Councillor Comfort.
Ditto to Councillor McCallum's remarks. And also, I think we're very lucky to have the auditing firm that we have, because they are very thorough, and they also are the auditors for similar communities in Alberta. So they have a real sense of what's going on and what to look for. So I really appreciate their work as well.
Yeah, I'll certainly support that comment. Any other discussion on the motion? Seeing none, I'll call the question. Those in favor? Opposed? Motion's carried unanimously, and I will move that the Finance Committee be adjourned. Those in favor? Opposed? We're adjourned. And yes, thanks again, Calvin. And
Michelle, she disappeared.
Sorry, she disappeared. Well, thank her for us, Calvin.
Absolutely.
And
Thanks
we'll
for having us.
Look forward to seeing you again next opportunity.